Stock started a fifth day in a row to the downside early, but again, the buy the dippers came back in. Were they enough to keep us bullish? Are we headed lower and the market is just kind of taking its time getting there? A departure from what we've seen before when we had sharp drops only to bounce immediately. I'm going to break down what our posture is. Have things changed a little bit from yesterday in terms of expectations for the rest of this week? I'm going to break that down. I'm going to break down another sector where the market is now shifting towards. So again, a really bullish market, kind of running out of gas. Everyone's going from one sector to the next to try to keep it going. We talked about consumer staples. There's another one with a trade idea from that in today's video. So let's go ahead and get started. Today is Tuesday, November the 14th, 2017. This is the Market Outlook video. My name is David Settle. Thank you very much for watching today. Welcome to those that are coming for the first time. Hope you keep coming back for more. Join this great community we have here. There's some great people that watch this video day after day. If you haven't already, subscribe to our YouTube channel. Hit that thumbs up right below the video. Let me know that you like this video. One-click feedback for me. Comment, scroll down even further, comment on something that you found useful today, that light bulb moment, something you learned from the video. In the description, click on that link for the email subscription to sign up for our daily newsletter, as well as fill out a survey. Let us know what you want in a new investor education company that Brandon Van Zee and I are looking to put together. Follow me on Twitter. And then you can see we got about, what, 50, you can see there on the screen, about 50 likes, 34 retweets. So like and retweet today's market forecast tweet. I always pin it to the very top of my feed. The more you do that, the more Twitter will recommend this video to anybody and everybody that follows me, that follows you, that follows this type of content. All right, well, let's go ahead and take a look at the S&P 500 first here with the market forecast indicator. Again, you can see that we have a strong bullish posture still. It is falling, but don't put a lot of stock into that yet because it's still above 80. Doesn't matter if it's going up, if it's going down, if it's going sideways. When it's above 80, it's strongly bullish according to the intermediate posture, right? That is the posture, strongly bullish until we see it break below 80. Once it breaks below 80, doesn't mean now it's strongly bearish. As much as we might think, oh, it's so overbought, it's got to now tank. Nope. You don't go from strong bullish trends to strong bearish moves. You go from strong bullish trends to weak bearish trends that then build on themselves to turn into weak bearish. If and when you do, because they happen, you saw that, we saw one kind of here. When you do see a strong bullish posture turn into a big bearish move immediately, that's usually, it's a buy the dip opportunity. We've seen that a lot in the last year or two. Brexit, there's been a lot of examples of where we've crashed from all-time highs. Not necessarily crashed, but a bigger move. And when that happens, we buy those dips. But those are big dips, and we buy those big dips if they last. Because what we've seen lately is they don't even last on an intraday basis. They're being bought up, and if they're opening gaps down, they're bought up almost immediately. So yeah, we buy those dips according to past precedent. Now you notice here, the near-term line is still above 50. It's still up. It's not in the reversal zone, but still in the upper half of the chart. Now we're looking at like day 14 of bearishness here. So that blue oval is still the near-term high because it's still at the highest point during this near-term run. So we've had a little pullback, even though it's forming a potential lower high. That's why I wouldn't be surprised if this stayed for like a 20-day run again and pushed us up to a slightly higher high before turning back down. But you can see a long lower shadow. So a third long lower shadow in the past couple of weeks. They've all ended around the 62% Fibonacci retracement of the near-term run that we're on right now. And as I've said before, when long lower shadows form, the lows of those shadows act as support levels. They can act as support. Doesn't mean that we can't trade within the range, but they can act as support. And if we're meant to get that near-term line down below 50 right now, with this falling intermediate line, still not below 80 though, but falling intermediate line, then we can trade with that range, produce a red arrow, which we haven't had a red arrow on the moving average in a long time. since early September. So it's been more than a couple of months. And then usually when you have strong bullish trends, you get that first arrow on the moving average. That's usually a buying opportunity too, at the low point there. So again, you know, if we get that near-term line below 50 the next day or two, and we finish around that low point maybe and form a red arrow on that moving average, and most likely get red arrow, we'll look at the other indicators here in a minute, then that will be a buying opportunity at that point. Now again, will it be a buying opportunity for a multi-month posture? No, because most likely the intermediate line is not going to get below 50, and the near term and the market sentiment's already above 90. So any new near-term bounce we get really dampen expectations. So you're not going to load up on speculative bullish directional plays when those happen, because of the conditions that we're in right now. Take a quick glance at some of these other major indexes. The Dow Jones Industrial Average looks very, very similar. Remember, its near-term line did pop down below 50 briefly. You can see 23,250 is a key level. A little bit of an intraday head and shoulders pattern forming there. The NASDAQ Composite looks very, very similar to the S&P 500. You can see the long lower shadows there. And then finally the Russell 2000, which does not look the same as the others, continues to be more bearish than the others, but still trading within the range of that shadow. Here you can see we had these shadows, we held, and then finally broke it, and then we continue lower, but we've got more long lower shadows here that we're going to just trade within that range without being too significantly bearish. One thing to keep an eye on is that near-term line has the potential right now of forming a bearish near-term high point. So a bearish high point, when we're on bearish trends, then you notice the near-term line doesn't peak up here above 80 when we're on bearish trends. It will get above 50, but it doesn't usually peak above 80. It peaks between 50 and 80, after only spending a few days, 2, 3, maybe 4 days up above 50, before coming back down and looking for a low point. So you notice we haven't been too bearish either, because the near-term lines avoided the reversal zone, like we saw over here. It hasn't been that bearish. There's been times where it's been close, but we finished these days off their lows and it's brought it back out. But we're continuing to form more bearish high points, and they're getting progressively lower. You can see this is the green Fibonacci retracements. You know, we still got potential to go down to 1450 there, which could coincide with a weak bearish run on the intermediate line on those large cap indexes too. And again, on the long-term view, we rarely will drop sharply from well above the 50-day moving average and the 200-day moving average. So again, strong momentum. We still got elevated momentum here, so that should dampen any potential expectations for big bearish moves. Just don't expect them. Don't load up on shorts. Now we can lower risk, but we don't have to speculate counter trend right now. We can balance, you know, portfolios, active portfolios, with some higher probability bearish trades so that they don't kill us if the trend continues. But you know, just to balance out, not necessarily overtake our active, but just to add some balance. But again, we don't get big bearish moves when MACD is this high on the 50 and 200-day moving averages. And of course, if you take a look at the 3 green arrows, we don't have 3 green arrows. We're still up above the 30-day moving average or the 6-week moving average. We're testing it. We're testing that we came down a little bit below that. We were below the 17-day moving average again. So we're testing the 17-day and now testing the 30 on an intraday basis. The MACD is falling. We're grinding closer towards zero, which means these lines are getting closer to each other. Of course, you've got that divergence that sets up the low in between as a target, so right around 2550 in that area, which happens to be that 23% Fibonacci retracement. That probably would coincide with the Russell 2000 pullback that we just talked about there. So there's some targets here we can look for on any short-term pullbacks. I mean, yeah, we're going to muddle around with these long lower shadows, but if they break, then that next target, which isn't very far away, will be 2550. And again, would actually be a really darn good thing. It probably won't bring the intermediate line below 50, but at least will provide at least a little bit of a buying opportunity to kind of muddle around here and maybe even get to new all-time highs. But give us a buying opportunity to be able to have a kind of a launch pad, even if it's not a big launch pad, but a launch pad that we can launch into this end of year seasonality with. Alright, so when we look at the intraday chart, you see how we're filling in that shadow. That's that long lower shadow right there from last week, from last Thursday. You see how we trade within it on an intraday basis. Pretty obvious here. And you can see we've hit 256.5 and now multiple times. Oh, there's those 3 long lower shadows that we saw on the daily chart. We did finish like all these other days. In fact, every single day for the last 1, 2, 3, 4, 5 days, with the low of the day was early in the day. Now this one was more towards the middle, but the low of the day was early in the day, every single one of these, and then we finished at the highs of the days, every single one of these. So you can see the bears are there. We're not getting low opens, high closes. We're not getting these bullish candles day after day, higher highs, higher lows. This is a lower high and a lower low. So the bears are trying to come in, but every time the bears come in, the bulls come up. So while it's not strongly bullish, the market posture says strongly bullish, but we put a little grain of salt on it here because strong bullish postures on intraday charts they're higher highs and higher lows. And the low of the day is early, the high that maybe a little bit of a a dip from yesterday's high, but then a move up to a higher high. We're not getting daily higher highs and higher lows here. We're getting lower highs and lower lows, and there's enough of a bearish move day by day. In fact, we've had 1, 2, 3, the last 4 days we've gapped down. Every one of these days. Here we 5 days in a row we've gapped down because we gapped down just a little bit. That was probably the smallest one, but we've had 3 pretty significant out of the 5 days, and that one's not too shabby either. 5 days in a row of gaps down, low points early, and then boom, we come in. The buy the dippers come in full force. We finish at the end of the day, but you notice how the volume. Here we had on Thursday we had a lot of volume. Everything else has been a little bit below average, but you see how that average is starting to slowly creep higher. That's more bearish when you see that volume creep higher. If you take a look at the range today, was just at 1 1/3 points, so that's just a little bit above average. We saw the volume was a little bit above average too. You see how they're creeping higher. Volatility is also creeping higher. It's not spiking up and then we just come right back down. Here we got one high, boom. We didn't get a bunch of green lines, green circles that were going higher. We kind of went sideways and then boom, then right back down. Here, you notice we're getting kind of successive higher ovals, which means we're getting peaks on these oscillators. We're kind of slowly creeping higher in volume, in trading ranges, and volatility. So again, this may be that time we finally get weak bearish intermediate posture. Now I'm not saying we're going to start a bearish long-term trend now, but again, I've been saying that we've been maturing in this posture, and that market sentiment line is extremely high. We've only seen that high in the last 20 years, above 90 one other time. So we're starting to see some technical signs of exhaustion, not necessarily just crazy risk aversion, but exhaustion, risk exhaustion, where the market's finding it hard to keep on chugging. We saw sector rotation lately into some safe haven areas, and that's been kind of keeping us up. And we'll see what today shows too later in the video as well. We take a look at the ratio of volatility. So a student showed me this chart that we can still get that ratio for now, at least on VIX to VXV, and I appreciate that. You can see on an intraday basis we're getting up to that 90 to 95 area. That's where right here, 90 to 95, that's where that neutral area is, but we're still closing. 85 is the sweet spot for bearishness. So it's kind of like the bears are in there, but they're not holding. Always makes me think of that Seinfeld bit about taking online car reservations. They're not holding that move up here, and so we're still holding on to this bullish posture. But again, signs of exhaustion, and the signs of exhaustion here are that we're getting up to that neutral area at the very least on an intraday basis. Whereas before, obviously, we didn't when we were down here. And for a long time over here, you see that we didn't. So, you know, we ran up at the end of October, got that 4-point range in the VIX. We're running up right now, getting pretty close to a 4-point range. Now, remember, a 4-point range is kind of a low point for a monthly range on volatility. So we're kind of getting that now. Whether or not we, again, that's the smallest number we typically get. So usually on a normal month, like not one of the most historically low volatility months we've ever had, we'll obviously get bigger ranges than just 4 points. So we'll keep that in mind, that we're kind of getting to that 4-point range now as volatility has been kind of chugging higher. Alright, so really quickly, the big news today on the economic calendar, sorry that it was the in terms of what's driving price action, we'll shift to that focus of our video, was the PPI. That was the biggest thing on the calendar. There was some chatter about, from a fiscal standpoint, a chatter about the tax reform bill and putting in a healthcare related item into that tax reform bill. So the market kind of had mixed messages there. You know, first of all, it's great. Well, if they're going to pass tax reform, they can get healthcare at the same time. Great. But also there was a little bit of bearishness when that first came out because of the idea that, well, if they're going to put that in there, then now that dooms the tax reform bill because they've already shown they hadn't voted yet for the healthcare reform, and so there's a little bit of mixed messages in that regard. But the biggest thing from an economic standpoint was the PPI, and look at the year-over-year. PPI is up over 2.5%. The core rate spiking up higher too. These are big moves on the inflation front. And you can see it's kind of kept the economic surprise index where it's at. But what it did to inflation or interest rate hike expectations was, you can see there's the 125, 150. That is one rate hike in December that's baked into the cake, right? So you notice the odds of us now only having that one by next June are dropping down to where now the odds of a second rate hike, which is this gray one, 175 to 200, it's over 20% now, higher than it's been ever, and almost to the point where, well, I guess we did have in March we had odds of, we were just over 20% to be there as well, but then came down all this year. But lately it's been rising up, now back over 20%. So we're almost to the point where we have higher odds of a second rate hike by next June than we do of not having any at all next year, aside from the one that's baked into the cake for December. So, and of course, today's data point, it's interesting how today's data point didn't increase the odds of a rate hike of the one rate hike. It only increased the odds of the 2 rate hikes by next year. So it's kind of interesting to see how we still didn't impact the fact that we're still about 45% odds of having the 1 by next June. And you can see if I go to look at March, so again it's 150, 175 are the odds for the 1. To see, okay, well, when are we going to get that? Well, you can see it's about the same odds that we'll get it in March as we do in June. And that's why the June contract is showing higher odds for the second one, because the odds of the first one, if we do get one, right now the market's saying it's going to be early. It's going to be by March. And again, the December, March, June, September, that's when the Fed has their press conferences. So that's kind of when they tend to make these decisions. And you can see pretty decent chance there. So you'd think, okay, well that means that the higher inflation and higher rate hike expectations should have raised bond yields. Nope. Bond prices were the highest performing asset class today. They took off. Gold took off. International stocks, at least developed markets, outpaced U.S. markets. Large cap stocks outpaced small caps for most of the day. Again, gold way outpacing crude oil with crude oil coming down a little bit Here's a chart of crude oil. You can see a big sharp drop today, but only, again, it's only retracement drop, right? It's not, this isn't trend changing move. It's the fact that we've had, you know, we've had a pretty decent run now from, whoops, not that one, sorry. I have to get used to these drawing tools on toss since I've been used to the profit charts more. But you can see it's basically just 38% retracement. So don't read a whole lot of stock into that. And of course, if we do come down below that Bollinger Band, that can be something to consider. We did do that before here, and still maintain the bullish trend. And you can see we can do that and still find some Fibonacci support. You know, now if we were breaking below like that 50% Fibonacci retracement or 62%, now then I'd be worried. But here we can break below that that exponential moving average in the middle and still hold this old high, which happens to line up at the 62%. So there's a lot of support for crude oil between here and 52.5 before you really start worrying about a change in this bullish long-term trend that's been on here for the latter part and for the last few months. You also see on the sector rotation chart it's been a move to safe haven for the last couple of weeks, and you see now, you know, again, we had, you know, there was a couple weeks before when I started doing these videos, consumer staples were like the worst performing sector. When everything was up, it was like the only one that was negative. Well, now the script has flipped. Right, so now you have utilities up, consumer staples up. In fact, the broader market is down over the past couple of weeks slightly. Technology and discretionary are leading, but look at your two worst performers, materials and industrials. And I've said this before, they are your economically sensitive sectors. They're the ones that when economic growth expectations are rising, they'll do better. When economic growth expectations aren't rising, they won't do better. And we'll see tomorrow new estimates for the GDP from the Atlanta Fed, and we've seen that there's been some bullish economic news from a sentiment survey. Is that going to translate into hard data, actual economic growth? We saw that the last quarter's GDP growth was mostly due to temporary factors, higher inventory numbers, and no imports, which is not necessarily a great thing because that means our consumers aren't buying. So, and right now, the equity rotation here is telling us that economic growth expectations, especially with yields falling on a day when inflation is rising pretty sharply, all that's kind of telling us don't buy into a strengthening economy here, because that's not what the markets are telling us. And remember, what I show you on that sector rotation chart is TLT, which is the longest term. Not necessarily the 10-year, which is what we see in the TNX. The TNX chart didn't drop. It dropped today, but not nearly as much as the even longer term. And those longer term, again, are more tied to economic growth expectations than anything else. Obviously, the shortest term are tied to interest rate hike expectations from the Fed. But the further out in time you go, even past 10 years, the more now we're going to be tied to what the economy is expected to do. And we see that they're coming down according to TLT. But one sector that's been doing really, really well, and one stock that's breaking out of multi-month sideways action here, is EIX, Edison International. It's a utility, but you notice it's got its moving average, the MACD, the stochastic, all green arrows, with strong volume today, breaking up to new 52-week highs. If I were to take a look at the Bollinger Bands for this, we'll go back to a daily chart and look at the Bollinger Bands for EIX, and breaking above those Bollinger Bands. Strong move in this particular utility that still, even though it's at all-time highs, is giving us a decent yield. I mean, not its best yield because it's at 52-week highs, but a decent yield when you compare it to like that 10-year note, the 10-year note, and the fact that you're getting this really strong technical breakout here. And you see from a long-term viewpoint, this is the 50 and 200-day moving averages. You can see that we had strong momentum, but then we kind of were grinding from a long-term view on this kind of ascending triangle. It brought the MACD down. Well, now we break out, and there's a chance that the MACD can go. You can see we had to break out over here in the early part of 2016. We rallied up for a while, a little bit of a pullback back to the 200-day moving average, but we rallied up. And so from a technical perspective, there's opportunity here, and again, from a sector rotation standpoint, you can see the market's shifting towards utilities. Yeah, they're not the sexiest sector out there. They're not technology. They're not momentum, but they're one of those safe haven areas that can hold up better during any kind of pullback. So again, it's still bullish. It's still something that can go up in a bull market too, but it's a way for us to rotate, kind of take risk off, like yesterday's trade example, and rotate into something that's a little bit more safe haven in some areas that are showing us some really decently bullish technicals. And if it doesn't hold up, so how would we know if it doesn't hold up? Well, what we teach is that you can say, okay, well, you've got resistance here, right about what, $81. If we were to break back down below $81, then the breakout didn't hold. And of course, stop orders can be placed below that low point, but before the green arrows. So if we were to get back down below the 77.5, then you definitely know it's not going to hold. And even then, if it breaks down into this muck here, you're still getting 2.5% a year in terms of dividends, with the opportunity that you can sell covered calls as well, and be able to add to that return and just let it muck around for a while. And hopefully, if there is any kind of longer term shakeup eventually, this can hold its value. Until it breaks below support, then you're like, okay, I'm done. I'm not going to ride this down just for that 2.6% annual dividend. So to summarize, the market continues to be strongly bullish, but is showing some signs of exhaustion. It's like my boy running at a cross-country meet. Starts off very strong, and he's not superstar cross-country, but he does it for fun. His friends are on the team, as most of you know. That's what high schoolers tend to do. But it's kind of fun to watch because he, towards that last, run, that last mile, his times for the first mile really good. For the second mile, okay. Third mile, starting to show some signs of exhaustion. And that's what the market's doing right now. Still going, still heading towards where it needs to go, but not as fast. And we see some rotation. And today's example, again, like yesterday, tries to take advantage of that rotation, see if we can benefit from that slow down and rotation into safer areas. So again, thank you for watching tonight. Thanks for those that came and found us for the first time. Come back tomorrow night. Remember, subscribe, like, and comment on the YouTube video below. Remember the email subscription and the survey in the description. So fill those two out if you haven't already. Also, follow me on Twitter and like today's market forecast tweet there. Have a great evening, everybody. We'll see you all tomorrow.